I'm Jo from the marketing team at NetWealth, and today we're delighted to have Jason Koo join us from Macquarie. He's going to look at the role of alternative investments in a diversified portfolio. Before I hand over to Jason, I'll run through some quick housekeeping. Financial advisors who've joined will receive 1 CPD point. To receive this point, you'll need to be online for at least 30 minutes. You will then receive your CPD details within the week. This webinar is being recorded, so everyone will receive a copy of the session and slides within the week. You can also submit questions via the question tab in the toolbar to the right of your screen, and we'll have time to answer these at the end of the session. Please be aware that the information shared today is general advice only and is not intended to be professional financial advice. A little bit about NetWealth. For those of you who don't know us, we're an ASX listed company nearing our 20th year, and our purpose is to help Australians see wealth differently and discover a brighter future. We provide investors with a range of investment and super solutions via our platform. Investors can manage their super and investments using our portfolio tools, access a range of reports and online charts to analyse their portfolio, and stay up to date with changes in the market by accessing live prices and charts on individual stocks. Our platform also supports financial advisors with a range of financial products and services to help manage their clients' investments and super. I now have the pleasure of introducing Jason. Having joined Macquarie in 2012, Jason is now the Portfolio Manager for the Macquarie Professional Series Global Alternatives Fund. He also contributes to the management of the Macquarie Professional Series. Jason holds a Bachelor of Commerce and Economics from the University of New South Wales and is a Certified Investment Management Analyst. I'll now hand over to Jason. Thank you.
Thank you, Jo, and thank you for those who are dialing in and listening. We are currently at all-time stock market highs, central bank activity, cheaper debt. These things have contributed to the extended equity market cycle, with market participants having the case of FOMO or fear of missing out, chasing higher performance. Could there be an over-reliance on equities within investor portfolios? Depending on who you ask, each investor will have a different response to this question. But if we are asking the question of when the inevitable upward trend of equities will end, I think we are asking the wrong question. After all, if we could perfectly time the market, we probably wouldn't be listening to this webinar, and we'd all be much more wealthy than we currently are right now. The question I'd rather be asking is, how do we as investors have a greater probability of achieving our portfolio's longer-term objectives? The sections throughout this webinar will be: 1, what are the benefits of diversification and why should I diversify? Secondly, we will look at the barriers to diversification, and we will be leaning on behavioural biases which are inherent within our decision making. Third, we will look at some techniques alternative managers implement to diversify their portfolio. And lastly, we will investigate on building a core alternative solution. But first, why diversify? Let me give you 2 examples of different investment experiences. The first shown on this slide is the experience of a portfolio of assets over an unexplained period of time. The performance on a periodic basis is inconsistent, but overall follows an upward trajectory. The second investment experience still has some variability in performance, but relative to the first experience is much more consistent on a periodic basis. The emphasis here is on the consistency of performance. Both portfolios get you to the same final point in terms of returns, but depending on how well you diversify, there is one where you may sleep better throughout relative to the other. If you are making plans on retiring or have retired and are projecting income on an investment, I think we can agree that those plans and projections are simpler for the investor who has the dark blue portfolio. The investor in the smoother portfolio has less risk of trying to time markets, where market activity will occur, or adjusting their incomes due to changes in their capital. The difference between these portfolios is the diversification embedded between the assets that make up the portfolio. Diversification creates that more consistent return profile. But let's explain what this diversification is. Diversification is an intuitive concept. Let's take two familiar stocks on the ASX 200, Commonwealth Bank and Westpac. Here we have plotted the monthly returns of each stock going back to July 2007. As expected, due to being impacted by a lot of similar factors, both being Australian banks, both listed on the same stock exchange, the monthly returns delivered have historically moved simultaneously, not only in direction, but also in magnitude. If we were to convert this chart so that we can see the strength of the relationship more clearly, we plot these monthly returns on a scatter plot. Each point corresponds to how each stock performed during any particular month. For example, the dot signified by the large circle in the bottom left quadrant is the month of May 2010, where the Commonwealth Bank lost 12.2% and Westpac lost 13.3% in the same month due to negative sentiment. Similarly, every other dot is another month. The strength of the relationship between the two series of returns can be summarized through a line of best fit and a number, which we call the correlation. Correlation is a number which on an absolute basis is between 0 and 100%. This number defines the direction and magnitude of movements between assets. In this case, the correlation between Commonwealth Bank and Westpac is 83%, which is highly correlated. If it were 100%, all the blue dots will be plotted on a straight line. If we are to broaden the universe beyond Australian stocks into international markets and plot the monthly returns of the ASX 200 against the United States S&P 500, we can see that the correlation is slightly less than that of the previous example, but it is still highly correlated at 76%. You can also see, especially at the extreme end of returns, where they occur for one index, whether that is positive or negative, they are likely to occur by a similar magnitude for the other index. Extending this one step further to an emerging market index, such as South Korea's KOSPI, the correlation drops once again, this time to 59%. There is more dispersion in the relationship, but is still very strong, especially at the extreme end of outcomes. Both indices still share the same worst month of October 2008. As you can see, equity investments across countries can only diversify your portfolio so much. On this slide, we can see that for a portfolio of correlated stocks, such as the Commonwealth Bank and Westpac at 83%, this doesn't have much impact on return consistency. Neither do portfolios containing international indices shown in the previous examples, such as the ASX combined with the S&P at 76%, or the ASX and KOSPI, which had a 59% correlation. To maximize the diversification benefit and improve the consistency of returns, we need to find assets as close as possible to the 0% correlation. This is where the diversification benefit kicks in exponentially and helps provide a smoother investment experience for clients. Macquarie Professional Series searches for those uncorrelated investments that can improve the consistency of return profiles for Australian investors. We have a strong preference to find those investments that have maximum impact on portfolios. That is, as close as possible to a 0% correlation. For our business, we identified those investments circled as alternatives. When we find uncorrelated assets and add it to our volatile portfolio shown earlier, we can turn it into one that has a much smoother ride, thus helping investors to better plan and project their financial futures. The benefit of alternatives is recognised by the Australian market, being the largest growth asset class at 22% per annum over the last 10 years. Albeit, this is off a low base, as the average allocation in sector funds is currently 8%. Amongst larger investors, such as insurers and sovereign wealth funds, this allocation is even larger. For example, Australia's largest investment fund by assets, at around 150 billion, the Future Fund, allocated roughly 14% of its portfolio to alternative assets. If you were to include private equity, property, and infrastructure to this statistic, this number jumps up further to 44%. So now we have gone through what diversification is, their benefits, and its relevance in the Australian market. Let's look at the reasons why people do not diversify their portfolio, or the barriers to diversification. Many financial textbooks will explain the benefits of diversification, and yet we can quickly forget those benefits. That is, the theory of long-term investing is well known, but it can be hard to put this into practice. Just because we know what a good diet is, doesn't necessarily mean it's easy to eat healthier on a consistent basis. There are a number of behavioral biases inherent in our minds that can tempt us away from employing a diversified portfolio. The first we will go through is familiarity bias. When we buy stocks, it's easy to buy one that we have a close affiliation with. Maybe we do grocery shopping at Woolworths, buy a phone plan with Telstra, or bank with an institution due to having a Dolomite account set up in primary school. We buy these stocks because we know their brand and that they are highly visible. However, buying purely on this basis might lead to missed opportunities. Missed opportunities like Appen Limited, which is listed on the ASX, which is a market leader in developing voice-to-text technology and services the likes of Apple, Facebook, and Google. The same can be said about asset classes. When we read the financial part of newspapers, we mainly read about companies' ability to generate profits and the stock market in general. We develop an affiliation with equities as a result, and thus we may be missing out on further opportunities that can diversify our portfolio. The next behavioral bias is recency bias. Recency bias is about putting a larger weight on recent information, and as a result, ignoring the bigger picture. The chart on this slide shows that at any point in time, the annual return you would have received for each of the previous 3 years if you had invested in the S&P 500 index. For example, if you were invested for 3 years and looked at your returns in September 2017, the large blue dot on the chart, you would have earned 9% each year. It has been a good time to be an equity investor. And if other parts of your portfolio haven't been as good, you may be questioning why you are in them at all. In fact, if you are to look at the average 3-year annual return of the S&P over the last 8 years since the GFC, it was an 11.8% return per annum. Again, this is a great outcome. But If you were to only look at this data, you would miss the full picture of equities moving in market cycles. We have picked the US stock index as it has the longest history, and the blue line is what we were previously looking at. With a fuller picture, we can see periods such as the GFC with the orange dot, where the S&P index experienced a negative 16% return per annum for the 3 years to February 2009. By putting a larger weight on recent market performance and ignoring the larger picture, that can tempt us away from diversifying our portfolio. The last behavioral bias I am going to cover today is confirmation bias. Confirmation bias relates to external sources validating our points of view, and thus stopping further investigation or research. One source of external validation may be league tables of best performing funds. Many of these league tables are focused on the shorter term. We often see 1-year league tables, 3-year league tables, maybe even 5-year league tables. If we look at the top performing multi-sector funds over the last 3 years to June 2019, we can see that the overwhelming majority, that is over 90%, had an equity and property allocation greater than 80%. As an investor whose portfolio contains this exposure to equities, our views may be confirmed that this type of allocation to equity investments is most appropriate. However, if we are to look at the exact same analysis to June 2011, none of our top 50 funds have an aggressive allocation to equities. In fact, you have to go beyond the top 150 to find one. But this doesn't seem like an appropriate league table to look at either. So what is the appropriate league table to look at? From our perspective, we need to look at a league table over the full market cycle. And how often do we see one of those? When we look at the last cycle, which is 15 years and counting, we see that more diversified sector funds make up the majority of the top 50 list. But not only do they make up the majority, these more diversified funds would have also had a much smoother investment experience. From looking at league tables, we can see how focus on the shorter term during not only an equity bull market, but also an equity bear market can deter our portfolios from diversifying. It may be worth pointing out that these same behavioral biases, such as familiarity, recency, and confirmation, are the same biases that create opportunity for active managers in the market. In a world of rapid technological development, there is more information in the market that is disseminated in a more timely fashion. However, there are many behavioral biases that mean we either do not process that information correctly or apply that information with suboptimal outcomes. As a business who grounds itself in active management, this is a good segue into how active managers diversify themselves to generate excess returns. So now that we have been through the behavioral barriers some investors have to diversification, and in the previous section, understanding diversification and its benefits, let's now go through some alternative techniques managers undertake to diversify and generate that 0% correlation to other investments. Alternatives and diversification are seen as synonymous with one another, but alternatives is such a broad universe. You are often left with a whole lot of jargon that may be confusing to dissect. Terms you may have heard, such as managed futures, global macro, market neutral, etc. The difficulty with alternative investments is that they are not defined by what they are. They are often defined by what they are not. That is, they are not traditional investments such as equities, bonds, or cash. When it comes down to the jargon terms, I tend not to get caught up too much in how they are labeled, but what they are doing differently to generate those uncorrelated returns. So let's go through some of these techniques employed by managers to achieve diversification. The first technique is directional positions. Alternatives can use different instruments to gain exposures to different markets. They allow to profit from both up and down movements in price. These are called directional positions. When trying to profit from rising prices, the investor is said to go long. When trying to profit from falling prices, the investor is said to go short. You can see examples of directional positions here for the ASX 200 index. Using these instruments through different markets immediately broadens the opportunity set. Instead of investing in equities, bonds, or cash, where we can only profit when they rise in value, we can now also invest in the Mexican peso, coffee, natural gas, and copper. Not only can we profit when they increase in value, that is, go long, we can also profit when they fall in value, when we go short. Hence, these positions can diversify a traditional bond and equity portfolio. The second technique to generate uncorrelated returns is by investing in price trends. It has been empirically proven that price movements can also move in different patterns or trends over time. As an example, you can see the sustained movements of the S&P index on the top right. Through different periods, there are both sustained upward trends, shown in the decade of 1990 and the period of the mid-2000s, as well as sustained downward trends, as seen through the tech crash in the early 2000s and the GFC. This can be applied to other markets as well, such as currencies and bonds, shown in the bottom two charts of the slide. To identify a trend, it is intuitive that you need at least two prices in a time series. For the trend investor, if prices start in an upward movement, they will attempt to profit by longing the asset in the hope that the trend will be sustained. If those two prices start a downward movement, the trend follower will short the asset. They will exit their long or short position once the trend has ceased or it has reversed. So by seeking to profit not just from upward trends, but also from downward trends, you can diversify your traditional bond and equity portfolio. The third technique for alternative managers is through fundamental investing. Fundamental investing gives us access to different return drivers. These return drivers are different depending on markets we are looking at. You can see on this slide that equities may be driven more by underlying company cash flows or earnings. Bonds, on the other hand, are driven more predominantly by central bank policy or inflation. Currencies can be driven by cross-border flows, and commodities by their individual supply and demand curves. For example, a colder winter than usual can lift electricity and energy prices, or a drought can lift prices of corn or grain. It is all about the supply and demand of the underlying commodity. Investing in different markets naturally diversifies traditional bond and equity portfolios due to accessing new fundamental drivers. When assessing an asset's value, we can look to fundamentals to find a particular asset's intrinsic value. For example, if invested in a stock, we might perform a discounted cash flow to come up with a company's intrinsic value. If the price is below an asset's intrinsic value, the investor will long the asset in the hope that the price will eventually move towards its intrinsic value. If the price is above its intrinsic value, the second blue dot on the chart it will short the asset. This is fundamental investing in practice, and you only need to compare today's price to today's intrinsic value. If we are to compare the fundamental investor to the trend follower, we can see that due to their different investment perspectives, they enter and exit their positions at different times. The fundamental investor will come in and exit early, while trend following investors will come in and exit late due to the timing of identifying the trend. Both investment styles have proven to profit over the longer term. It's just that these profits occur at different points in time. The last technique I will go through with you today is relative value investing. This investment technique does not rely on correctly forecasting asset directions to profit. Rather, they rely on correctly selecting the outperforming asset. Let's go through the examples shown on the slide. Both scenarios believe the ASX 200 is going to outperform the S&P 500. In order to capitalize on the outperformance, the investment manager will place a long position on the ASX, the outperforming asset. The asset in which the ASX is hoping to outperform against, in this case it's the S&P, will have an equal short position. As you can see on both charts, it doesn't matter if the ASX or S&P rises or falls in value. As long as the ASX outperforms the S&P, profits will be made. Again, this technique can be used to diversify a traditional bond and equity portfolio. So to recap this section, alternative managers simply have a broader opportunity set by utilizing different instruments that allow it to gain exposure to different markets. The 4 techniques I have gone through that allow alternative managers to develop uncorrelated returns are through the use of directional positions, trend following, fundamental investing, and relative value investing. There are many more nuanced differences in signals and implementation between managers and strategies to generate uncorrelated returns. However, hopefully through these simplified examples that I have used, this gives you a taste of how alternative managers can add new return drivers to diversify traditional equity bond portfolios. So how do we harness what we know to build a core alternative solution? This is the last part of the presentation, and I will be mainly talking about this from a business's perspective. What Macquarie Professional Series has seen during the last decade of alternatives growth is clients acknowledging the need to diversify their equity exposures, but a lack of confidence or maybe education implementing this in practice. With the current environment conducive to equity outperformance, especially over the last 8 years, some investors have been impatient with short-term performance and volatility. To minimize some of the pitfalls of exiting alternatives before the current market environment changes and you need diversification the most, we need to build a robust core alternatives allocation. So how has Macquarie Professional Series gone about this? The first step is through a highly selective manager search and selection process. Over the last 14 years, Macquarie Professional Series has searched the world and met with over 200 alternative managers to try and identify those that are most impactful on Australian investor portfolios. In the beginning of the business in the early 2000s, this was purely about finding strategies that were complementary to equity portfolios with the same liquidity profile as equities. That is, specifically those alternative investments that can be applied and redeemed to cash on a daily basis. We wanted to diversify from equities as there was a large bias amongst local investors to this asset class, in particular Australian equities. Winton, based in London, invests in close to 100 markets, covering equities, bonds, currencies, and commodities. The fund predominantly invests in trends, identified through a deep scientific approach via directional positions. These techniques were illustrated in the previous section. Winton are one of the longest standing fund managers in this space. And when we launched the fund in the Australian market in 2007, they were Australia's first daily liquid trend following fund. This also happened to be Winton's first daily liquid account globally. The value of Winton's fund and its diversification benefits was seen throughout the GFC, where the fund performed 26% in 2008, when Australian equities fell 39%. During 2011, the fund performed 10%, when Australian equities fell 11%. This isn't to say that Winton will perform like this during the next equity downturn. However, this performance does illustrate that Winton has the potential to provide returns irrespective of equity market direction. Since the GFC, a proliferation of other trend-following managers entered the Australian market, in addition to fundamental managers with directional trades on assets such as equities. To diversify liquid alternative allocations further, our business found a relative value manager in Stockholm, Sweden, named IPM. Why did we look at Sweden? We didn't know this at the beginning of our search, but the country bats above its weight in terms of innovation, exemplified by companies such as Spotify and Skype, to name a few. Sweden was also a leader in hedge funds, managing the third largest amount of hedge funds in Europe, with Swedish clients also aggressive allocators to alternatives. IPM provided innovative techniques to well-known and defined financial theoretical principles. But unlike Winton, IPM had a stronger emphasis on fundamental investing through relative value trades. IPM's strategy has a low correlation to trend-following dominant funds and other recognized directional fundamental strategies. It is important to note that while low correlations are important, so are long-term performance numbers. We found that IPM also had over a decade-long track record through various market environments such as the GFC. During that same time, when we were deep in our search for diversifying liquid alternatives, we had also come across PE Global, a Boston-based currency investor. They employed directional views to 15 currencies through a dynamic fundamental approach with a track record going back to 2003. This dynamic approach was not only unique, but was also shown to be successful in an asset class which has historically been known to be difficult in extracting consistent positive returns. Again, this is a strategy that has a very low long-term correlation to our other liquid alternatives, such as Winton and IPM, as well as other well-known alternatives available to Australian investors. You can see on this slide each alternative manager we have picked to represent in the Australian market. While there may be some overlap in markets traded, there is minimal overlap in the diversification techniques. This helps us explain the very low long-term correlations between the strategies and how they can be useful diversifiers to not only equities and bonds, but also to each other in potentially providing smoother returns. The result of combining investments with low correlation is a more consistent return profile to not only a portfolio consisting of traditional asset classes, but also within our alternatives allocation itself. Now we have the components of our alternative solution. We need to combine them in a smart way to maximize the diversification benefit. In order to do this, we assess the risks in each strategy to come up with an appropriate allocation for each. Some of these risks include the return consistency of the strategies themselves, the breadth of opportunities provided by each manager, and their potential for short-term capital losses. We carefully consider these risks and combine the strategies with the aim of providing higher returns with a smoother overall experience for the client. If we are to revisit this chart from earlier today, we can clearly see the benefits of combining lowly correlated investments together. So back to the original topic of stocks are rallying, why diversify? Hopefully this presentation gives you an insight as to why diversification is beneficial for long-term return consistency. This consistency allows for better planning or forecasting for events such as accumulation or retirement. While we don't necessarily disagree that stocks should be doing the heavy lifting within portfolios, this obviously justified by the return premium earned in these markets, we need to ask ourselves where our portfolio returns will be coming from if the equity market enters a sustained period of underperformance. Between August 2002 and August 2012, global equity exposures delivered 0%. That is 10 long years without any return from global equity exposures. Carefully selected alternative investments have the potential to help generate returns in such an environment. Thank you for listening, and I hope you've gained some insight into the role of diversification today.
Thank you, Jason. That was really informative. I'll just wait online for a little bit. Feel free to send through any questions as we've got a bit of time, so we're likely to get through them all. And then we'll go from there. Okay, here's one. Do you think there is a shortage of alternative strategies considered suitable for the retail market and that are appropriately priced?
That's a good question. So in terms of the shortage of alternative investments, I believe that MPS tries to find those investments that are underrepresented or find the gaps within the Australian market. So we've definitely tried to find those alternative investments that are most useful for the Australian market. We have seen a growth of alternatives and more alternative managers come into the market. A lot of them have the same return drivers. So over the last 5 to 7 years, our business has been really focused on finding those investment return drivers that are unique to the investment universe that we currently have in the retail market. And so with IPM and PE, we've done statistical analysis to show that the return drivers and the overlap of those return drivers is quite minimal. And we use that from principal components analysis. As to whether these are appropriately priced, we'd like to see from a manager selection point of view that these businesses are sustainable on a management fee basis. We see that those that command a higher fee are those that invest heavily into research, so that management fee is continually reinvested into finding more uncorrelated signals. So with IPM and PE in particular, and also Winton in diversifying from its major component in trend following, we've seen a lot of research, and that's from the reinvestment of those management fees back into providing more diversified and uncorrelated portfolios. So it really does depend on a case-by-case basis, but we are seeing that the Australian market, especially at the retail end, is becoming more sophisticated in how they construct portfolios in general.
Thank you. So managed funds seem to lack transparency in what investments they may hold. Does this transparency completely disappear with alternative investments?
Yeah, this has been a long bugbear in terms of the alternatives community. Over the last decade, we have seen a lot more transparency from alternative managers and hedge funds. They realize that in order to get on side with gatekeepers who recommend and approve and rate their products, that they need to open up the bonnet a little bit more. And so, you know, there has been a demand for more transparency, and the managers have delivered upon that. Especially when we look for managers, we definitely want to see that transparency available. So when we construct our global alternatives portfolio, each manager that we've partnered up with, we actually write into our mandate and our contracts daily transparency into what they're holding, and we conduct independent risk analysis on that. So for our global alternative solution, we're able to conduct stress tests and really ask them what's driving their portfolio performance, as well as what are their underlying signals.
Do you view alternatives as a sort of insurance policy for an equity-heavy portfolio?
Yeah, that's a good question. And I don't believe that alternatives should be used as insurance. When we look at the main drivers of alternatives and what their benefit is and what their role is within the broader portfolio, it's to provide returns during prolonged periods where equity markets aren't delivering. That isn't to say that it is insurance. Insurance would be like shorting equity index futures or buying put options, where you generate positive returns when equity markets fall. So I wouldn't view it as an insurance policy. I would view it more from the perspective as an ability to add new return drivers to your portfolio that work irrespective of whether equity markets are rising or falling. And that has benefits of increasing overall portfolio risk-adjusted returns, which can simultaneously both reduce risk and increase potential returns at the same time. Portfolio insurance is unable to do that.
Okay, several well-renowned alternative managers, including Winton, have experienced significant outflows in recent years. Why do you think this is the case?
Yeah, that's also a good question. So there have been some outflows from our funds. And I think that's due to the volatility of some of these single strategies, as well as their drawdown profiles. So alternatives by no means is meant to be a large allocation within your strategic asset allocation. And as I went through, multi-sector funds, that's currently at 8%. And for your institutional investors, that's in double digits. However, you know, I feel like some clients are consistently comparing their alternative investments to equity market performance. So if they haven't kept up with equity markets, clients would be asking, and advisors will be asking, well, why am I in this investment at all? What we've seen over the last 8 years is one particular market environment which has been conducive to equity outperformance, and also bonds as well. You can throw that in there. What we should be asking is, on a forward-looking basis, will this current environment be sustainable to allow that continuance of equity outperformance? So I think we've also went through the slides of the league tables. If you look at the full market cycle, alternatives definitely has a role to play, and you definitely want that consistency of performance, which can be done through as little as an 8% allocation to alternatives.
Thank you. There's a few more. What are your thoughts on those alternative managers with a significant allocation to equities at this point in the cycle? That can't be great for diversification of your overall portfolio. It is also a costly equity exposure given the charge on these funds.
Yeah, I can't speak for other managers out there in the market, but what I can say is the managers that we do have in our current suite, we do the stress tests on equity markets of how they would perform during equity markets rising and falling, and we like to see that there is minimal impact on strong movements and volatile movements in equity markets. Yeah, a key consideration of onboarding these managers and strategies onto Macquarie Professional Series is that they have minimal equity beta within their products.
Thank you. On one of your slides on alternatives, I saw gold listed at, in the word cloud. Does Macquarie have any products that are focused on precious metals, physical holdings and mining companies, not ETFs?
Macquarie Investment Management, which is the group I am a part of, doesn't have any products that have gold within them. We see investor demand. They like the idea of gold and precious metals, but it's much more conducive and better for longer term investing as a part of a more diversified portfolio. So Winton does invest in gold, but that's just one of their 100 futures contracts that they do invest in.
Thank you. Are alternatives generally liquid, or do they provide greater upside in down markets because they are invested in illiquid assets, such as property trusts or company loans?
Yeah, so our business has focused on liquid, daily liquid strategies. So all the strategies that I went through in IPM, Winton, and PE, they all have daily liquidity. There is a illiquidity premium for those investments, such as private equity and private debt strategies and infrastructure strategies. That does come with investing in those funds due to the longer lockup periods. We focus on those that investors like, especially on the retail end, and retail investors really like liquidity, as you are seen during the global financial crisis. So when investors couldn't pull out their money during the GFC, you know, these investments could be essentially used like an ATM, and you can pull out your money and liquidate some of your holdings on a daily basis.
Thank you. We'll just go to two final questions. Market neutral funds, which hold equal number of long and short equity positions, are currently charging performance fees for merely beating the RBA cash rate. How do they justify this? Also, performance on many of them has been dismal, even though they are supposed to be able to deliver positive returns in both up markets and down markets. Any comments on market neutral funds?
We don't have an equity market neutral fund, but IPM does have it does undertake a relative value approach where 85% of its risk has equal long and short positions. It does come down to capturing idiosyncratic risk. So what market neutral strategies try and do is remove the impact of equity beta and try and profit from risks that aren't embedded within equity markets. Try and pick up differentiated risk factors within equity markets, essentially. And IPM does this across not only equities, but bonds, as well as currencies. We find that, yeah, it has been a tough time for them, but there is a time and a place and a role for them in investor portfolios as well. We just need to see a little bit more dispersion in equity markets for them to really deliver. And we've looked at different market regimes of when these market neutral strategies do deliver, and most of them have been during rising volatility environments, as well as environments where there is a lot of dispersion within asset classes. The market environment that we've seen, especially over the last 3 to 5 years, has been one where, you know, it's been continuously lower, falling volatility levels and a lack of dispersion within markets. If that were to change on a forward-looking basis, there could be some opportunities for those market neutral funds, and funds such as IPM.
Thank you. And final question. This is reflective, identified of your familiarity basis. How do you overcome challenges of investors viewing some alternative strategies such as managed futures as a black box?
Yeah, we've tried to be as transparent as possible with the investors with what we can. Obviously, with the more unique strategies, they do have a limited capacity for those strategies, and they'd like to protect that capacity to allow a sustainable business model. And a part of that is protecting their IP, especially when they're able to extract alpha in a very competitive market. So, you know, a lot of the investments have been as transparent as possible as they can be, while protecting alpha and their own business models, because we all know what happens when they are a little bit too transparent, and a lot of these products can become smart beta or alternative beta products and can erode alpha opportunities over the longer term.
Great, thanks very much. We'll wrap up there. Just wanted to thank you again, Jason, for your time, and thanks everyone for joining us. As a reminder, if you've been online for 30 minutes or more, you'll receive a CBD point and the slides within the week. And in case you're interested, you can view all the managed funds and their performance on our platform. Just visit the Compare Funds and Models page, which can be found on our website under the Personal tab, then Research and Tools.